All right, what's up, everybody? I am doing another Moneyball interview. I am loving this series, learning something new every time. But today it is Bill Dallas. Bill has been a good friend and a mentor of mine for I feels like my entire mortgage career, Bill.
Man, we've known each other a long time, dude.
Yeah, a long time. I don't know if this is my 38th or 39th year. Um,
Mm.
but when I got pretty successful at mortgage, I was doing a lot of loans, and there was this company called First Franklin, which Bill Dallas was the co-founder and CEO of, and it was not only a really important business relationship during my early days of my career, but I learned a lot of things from Bill. The way he would interview his best customers, I remember you brought me and a dozen other great customers up to your house for I don't know, 3 or 4 days. We golfed, we learned, you listened, and that has really shaped my life as an entrepreneur. So thank you, Bill.
You're welcome, buddy. No, it's shaped mine too. I mean, it's funny, all of us met in low places when we
Right. Well, no,
started.
you had a pretty damn nice house when I met you. You were not in a low place, bro. You helped me oh, I want to have a house like Bill Dallas someday.
Aspire.
Yeah.
That's right. Yeah. I do the same with my kids. All, 5 of my kids are, in homes. And so I think Angelo Mazzillo, who you and I know, and I know he's controversial to some, but not to me. When I started, I looked up to Countrywide and Angelo and different people in the industry, from the directors folks. And there were just some very independent people. And my best friend, Mark Oman, who was at Wells at the time. But Angelo said one thing pretty cool to me, which was, I said, and I love to ask this question. If you had it to do over, or if you, looking back, is there something that you would focus on that you would do now that you just didn't do, and you did too late in life? He says, yep, buy the big house and get everybody in it right then, as fast as you can. And I went, And then we became neighbors at Sherwood over years. So he was right? Build it and they will come, and the kids still come back. And so it's really cool.
Yeah, well, I took that advice and have a big enough house in Newport Beach that each of my kids can be here and have their own room.
Yeah.
And anyways, well, you've been an inspiration for me, and
thank you.
and
too.
And you've really made an impact on this industry. And Kristen Messerly and I did an interview with you. It was probably a month or two ago. I'm going to put a link down below. It was really cool. Kristen, as the co-founder of First Home IQ, talked a lot about your schools and just what you're doing to help the next generation. By the way, folks, check that out. It's linked down below. But this is about Moneyball Mortgage. And so, I'm doing a similar format with different people. So I want to follow the same format with you. I know you watched my interview with Jim Deitch, and
yeah,
and this
man, this is painful. Painful to look at.
Yeah. But here's I want to frame this for anyone that's like, this is the first of the Moneyball interviews that you've watched, that this top tier loan officers has nothing to do with how many loans they close, where they're at in the leaderboard, or what their production is, or what their personal commission is. It has everything to do with, from a company's perspective, are they making money per loan? And this is an IMB, and they had in this quarter, they had 335 loans that were averaging $2,400 in profit. And then they had their second tier loan officers. And Jim says, when I do this, sometimes they're making a couple hundred, sometimes they're losing a couple hundred. In this case, they're losing 366. And then there's this bottom tier, and there's 569 loans that are losing $5,000. And so, a couple questions, Bill. First of all, is this how you see it? How accurate is this from your view of the mortgage industry right now?
Yeah, it's a good question, right? I think I'll go back initially, right? So cost to produce a loan in 2000 was probably $2,000 a loan. And if you go fast forward to today, you're at $10,000 to $15,000, depending on who's zooming who and what you count. And so what's changed?
But what is it today?
I think
You said
10 to 15,000.
Yeah, right.
Depending upon the company. Now, and it didn't get much better when we were doing lots of volume. What got better was your number of loans per LO got better. But so I think it's hinting to you that the model's broken. And so when I started into retail, when I started First Franklin, we were all retail. And so then I went TPO for a while when I met you for a long time. So again, getting back into Finance of America when I was there, one of the things that we've developed was a loan officer scorecard, and we used that forever. And we used it for two things. One, to measure what you just showed, who's zooming who are my profitable LOs, and let's focus on them. And the second thing was trying to figure out how to compensate them. And, when Dodd-Frank came out, it pretty much created some of these problems for us, because you can't pay really on anything. You can't pay on differences of loans, and you can't incentivize really people to do more revenue by product. So, but you can measure. And so what we started to do at that time was build LO scorecards to create variable comp. And in variable comp, we had deferred comp plans that we gave people to retain them. And I think, and those deferred comp things could be based on performance-oriented stuff all around volume and different things like loan quality or purchase volume or whatever you wanted. So I think you're right. I think the problem is we've got way too many LOs. We've got way too many LOAs. And the cost to produce a loan is killing everybody. And then in order to pay for that, you then have to increase price. And that is frustrating most. You see a lot of people moving back to broker in order, because it's a little bit easier when you're a mortgage broker to handle the concession part of the loan and closing the loan. And I think it's also to some a better price, because you don't have all this noise and all these costs that retail people have. And if you go back to when we started, right, mortgage has always been this teeter-totter of who's controlling point of sale. And so there was a point where, hey, we're going to outsource it. Everybody's going into third party. Then there was, after 2006, 7, and 8, everybody got back into retail and everybody killed the broker model. And then in between, you have banks winning, S&Ls winning, mortgage banks winning. Yeah. And so here we are, right? And I think Moneyball, Dee Potesta's book, I mean, I'm an athlete and played baseball in college. And I just think it is the way to think about what you're doing, because you do this to make money. You don't do this for any other reason, right? And if you own a business. Now, there are very cool missions, serve the underserved. I mean, all the things that we love about what we do, providing housing and all that stuff is just cool. And that's why you and I love it. I mean, we've loved this business for so long because of what it can do to transform lives. But it also can really hurt the people in the mortgage business if you don't work for companies that are well run and understand, because the business just whipsaws you, right? The macro part of it is just terrible. So Moneyball, to me, I think some of the Moneyball things, these are just off the top of my head when I read Dee Potesta's book a long time ago. Some of you have seen the movie and everything else, but I love the way he started with the curse of talent and the anatomy of an undervalued player. And then this science of winning an unfair game. I mean, like when I used to coach, it was like baseball is a series of 2-out hits and 1-run games. And if you want to win, you got to win 1-run games. You just watch the World Series, for crying sakes. 2 teams you didn't even know existed. And so I think you have to use analytics like you're using to support your gut. And then you have to build a franchise that can compete. And it doesn't have to be a bunch of superstars, right? So I agree with you.
So let's go to the next chapter of this conversation, because I also have this thesis that just about every lender can be profitable today in this market without having to make a bunch of layoffs and cut. Now, by the way, that's assuming that you've already made the right cuts, and to get to where we're at, cuts needed to happen, and hopefully, but there is a lot of profits on the table in your current funnel that don't require letting people go. So remember, this tier one has nothing to do with production. And I asked Jim, what's the biggest difference between the tier three and the tier one? And the answer was concessions and conversion. And I want to walk through, this is part of the same anonymized case study, where when you really start looking at conversion, like this is the funnel. Look at this. Concessions in this particular funnel, there are 40 basis points. So in at least 50% of pricing concessions don't need to happen if a loan officer follows best practices on how they deliver rates and fees. And when they do negotiate, and I'm not saying you won't have any, you will absolutely have concessions in this market, but if you negotiate in a best practice way, you can reduce the size. You could cut the number of them in half, and you could cut the size in half. And then withdrawn loans, another plus 40. I mean, this particular funnel has 99 basis points leaking. I had my team make a little bucket, like, guys, there's a lot of leaks in your current funnel. So if you're a CEO, you're an executive watching this, how many leaks, unnecessary, by the way, unnecessary leaks do you have? And while you can't kill concessions, you're going to have a leak, but could you take whatever you're at right now and cut it in half? I say yes, everybody can cut this half. If you better trained your loan officers, and they took better apps, they had better commitment with the consumer, and they set better expectations, and they knew how to negotiate conflict, constructive tension better, you could cut this in half. So first of all, before I go on, do you align on that like literally we could fix the buckets we have with training and best practices?
Yeah, I think obviously, right, that it almost yells at you, right, to say, what's the difference between, because I would add one thing. I mean, the difference between the top tier LO and the bottom tier is the bottom tier have no database. The bottom tier, they're scraping around, right? So I don't find very many people. Well, I do find some rate sensitive people who just can't sell in a rate environment. They're so used to interest rates dropping and being refinance oriented that it's very difficult for them. And they bitch all the time about price. So there's always a concession and blah, blah, blah. Everything else I think you said is really true. And when I watched yours and Jim's and then Todd's, and as you watch these people talk about Moneyball, I think what we're learning is that it's the Murphy's Law component, where 20% of the people really do 80% of your volume and are really good at what they do. The question is, what do you do with tier 2 and tier 3? And I think the first thing you do is you identify them and the problem and the challenge, and then you have to train them up or move them out, right? They can't be involved. The other thing I think in the model is the LOA and the processor and the way the system is sort of segmented, the way the loan processing system and process is sort of segmented itself, has dumbed down the LO. And most good LOs today and most good AEs today are deal structurers. They understand how to get a deal done in tough environments like this and all the other options. So I think you have to focus on training, and obviously the leakage. Most mortgage companies, and I have 7 or 8 customers today I work with, clients, big, small, and I try to pick them based upon, I think, their ability to compete in this market. I think they all suffer a little bit from, they don't analyze the data like you just showed. So they don't know the real problem or the real challenge. And then there's very little training to how to help a person do that, right? Your product with Trust Engine and everything you stood for is trying to make it easier for an LO to up their game, to become more professional, but also help the customer make a good decision. That doesn't necessarily mean, I've got to go search 3,000 places for different rates. I trust you. And oh, by the way, I'll work with you on trying to find a solution for my loan. But prospecting, you look at conversion, it really is a conversion problem. They see customers, they just don't convert them. And when they do have them, in order to convert them, they gotta almost give away the store for this to happen. And it's not easy, right? So, and then when you move into a complicated market like we are today, where you've got to use other tools, whether they're buy downs or buy ups, or whether they are not, whether it's non-QM and you're using DSCR or asset depletion or something else to help them qualify, they just don't understand it. And rates are high, so people are butting up against DTI quotients. And I think it just is it's always been an issue. I think what's killing retail, and if we play Moneyball today, is you have to find the talent. You have to, because it's much easier for me to get a top producer to do another loan and close one more than it is to get a bottom tiered person to actually produce. So how do I do, and should I do both? Now, and the way that these businesses have become structured is they suddenly taken this, what I'm going to call the net branch model, and they've loaded it with people. So not only do you have all these massive costs, you've lost control of doing that and given control to 50 or 60 different teams to do just what you just said, right? Which is train the person, measure it well, weed the garden, make sure so I think it becomes, and that's what I see. It's very difficult for companies to actually do this because they don't have control of each of these teams. And they're afraid to move the chess piece because then everybody will move to a different company. And I'm taking my bag and balls and bats and I'm going someplace else. I'm going to go over and play over here.
Yeah, no, you are so right. So let's get kind of more tactical. Like, we've identified a few problems. You called out another one. I called out just like, hey, how much money is in the current loan funnel? And you made the point that, hey, man, there's a whole funnel that's even bigger, and that's, guys, your database. Obviously something that we obsess on at Trust Engine. Jim thought that the funnel above was 4x a bigger opportunity than this. Guys, I'll tell you, it's 10x. While it may be 4x in terms of overall size, but because most lenders and loan officers do such a bad job of doing it, if you're listening to this, there's a really good chance that if you really measure how many loans you're losing out of your database every month and every quarter versus how many you're keeping, that if you really applied best practices and technologies like Trust Engine, it would be 10x. Like you do not need to be losing money. You can fix this funnel. You have the technology now to fix this funnel. And so here's I'm going to get tactical, Bill, and I want to get your thoughts. So, obviously we talked about in funnel, from the time that you run a credit report to the time that you close a loan. We talked about price sections and just, you can't eliminate them, but you can optimize them. Mm-hmm. We talked about above the funnel, which is right here. And so here's my solution. I want to get your thoughts on it. And this is the algorithm. This is my recommendation to the industry. And I want to see if you agree with this. Put loans per closed loan at the bottom, volume at the bottom, So when you're scorecarding your loan officers, like we're still scorecarding on volume because hey, we're competitive,
We're volume.
elite,
Yep.
their numbers,
Yep.
they matter. But what if you put conversion, like credit report to close loan right next to that so that everyone knew like conversion and you competed. And the loan officers that have the best conversion in your organization were sharing how they had the best conversion. What if you put price concessions? Like I think of that as a sales fitness score. If you're at a company and you're in the top 10% within your company, in terms of low concessions, hey, you're a value salesperson. You're doing it right. You got high conversion, you got low concessions. By the way, if you're in the bottom 50%, like transparency, let's know it. And then let's also have a metric and know the conversion within the funnel. And we scorecarded this. So any thoughts, one, on is that a good idea? And then two, well, first of all, is that a good idea?
Yeah, I think I'll throw it into a big picture because I do think that's a good idea, right? But I go back to things that I'm going to use books or things that I've read or worked on as an executive over time. You measure what matters, right? And if what matters, like if anything that I've done in any of the businesses that I've owned, if I measure it because it matters, it gets done and I fix it. This can easily be fixed. And it just has to be that you have to focus on it. And I think so let's think about it. So the way that, if you put that slide back up here, right, and look at it, the way that you manage those 5 things today in mortgage is we have regional managers and branch managers and people that really don't understand things. And they are managing what we call the pipeline. Right. So you have a pipeline.
But by the way, did you really want me to put this back up, or are you just saying figuratively?
Because when you look at it, right, when you look at these 5 things, it becomes your pipeline because conversion really is the movement from app. And we all hedge all of our losses, all of our gains, and everything that we do. They all come about because we're managing a loan as it migrates through. The business has changed dramatically with derivative assets and derivative asset accounting because we value your lock right, and that's where everything is valued. So we're trying to get the customer to go from an app to a lock, and the lock is valuable. And then from lock to funding, we measure a percentage, and that percentage is everything that we do in accounting and everything we do in mortgage is based upon that today. So we forward look at locks, and our pull through gives us a valuation, and that becomes our revenue, right? And yet mortgage, I go to a branch manager or to somebody else, they don't understand any of this. So I think it starts with, because what you just identified is really pipeline management, derivative lock accounting, and your financial and your income statement, to a branch. And what happens is loan officers get so focused, and I think this is where you were going, to the closing of the deal. But on both sides of that deal, every company has somewhere between 10 and 30% fallout. And then you've got a customer and you sell the servicing. So you need to retain the customer on this side after closing, maybe sell them other products that stay connected to them. And then you have to go back into your fallout. 25% of your deals have fallen out. These are real customers. And I guarantee you, if I gave that customer to Dave Savage to close, the likelihood of Dave closing that, or Todd Screama, or one of his, if I give it to a top person who knows what they're doing, your conversion goes way, way up. So the question always for me is, so I've got these tiered people with loans in the pipeline, or they're going to fall out. So the first thing I focus on is fallout. And the second thing I focus on is retention. Those are layups. Now I got to go get new deals. Okay. That's what you're supposed to do as a loan officer, right? So in that measurement, I think, is where the business actually fails today.
Agreed. So here's another. I'm gonna go through a best practice, using MortgageCoach and philosophies that we have, and then I want to kind of get your feedback on how to get more managers to do what I think they need to do, so they can literally come out of this video with vision and strategy to improve profitability today. And by the way, and do improve profitability in a way today that you're profitable today, and that you're going to accelerate your growth and profitability as rates go down. So first of all, you said what gets measured gets improved. And if you just focused on these two things, and you made sure that not only were you measuring it, but your branch managers knew it, your regionals knew it, collectively as a culture, you celebrated these things. You knew them, you celebrated them along with production. So that's one, which, by the way, I do not know too many lenders that have a dashboard like this where the branch managers know it, the loan officers know it, the regional managers know it, and it's celebrated. So first of all, let's just assume almost no one is doing this right now. And then something else I talk a lot about, like our entire career, Bill, you and I have experienced rates going down, and they went down to 2%, and they're never going to go that back. And we also have lived in an era where speed to lead was enough to win. Like if you were the first one there, you won most of the time. And I think we live in an era now where it's about speed to need. Like we got to get there first, but you also need to get to the consumer, like get to their needs. And so I'm going to give an example. This is a total cost analysis. And I know for a fact, because I've run the data, that, I could show case study after case study where the loan officers at a company that uses MortgageCoach, the ones that use this are costing the company at least 10 basis points more. In FM, it's actually 65 basis points. Like the loan officers that use this are 65 basis points less profitable. I just got a case study last week from Churchill Mortgage, and last month the non-MortgageCoach loan officers were 41 basis points less profitable. And the loan officers that do this, they have a 10% higher conversion rate. They have left price exception because they're showing options. Hey, like 2 points, 1 point, no points. And then they're showing, hey, I got you. Like rates are coming down. And when they come down, I'll refinance. In the mortgage industry, it's called date the rate, marry the house. And so one thing we know at a data-driven level, that if a loan officer delivers this type of a presentation, they're more profitable. And then when you negotiate a concession, this is another thing that we're like, best practice number one, options, and always show the refi in this market. Best practice number two, when you negotiate an exception, you don't negotiate with interest rates and basis points. You negotiate with dollars. You show the consumer the difference between, like, let's say they're getting 0.5% better at the other lender. Okay, that's $2,000 over the next 12 months. And now you could go to the consumer and go, hey, if I am able to, do a seller credit of $500, $1,000, even if you did a seller credit of $2,000, it'd be a lot better than lowering the rate by a quarter or 3/8 to win the deal. So now, Bill, we know for a fact that the lenders that do this are more profitable. They close more loans, but here's the challenge. Lenders are doing better. Like obviously we've grown as a company, but they're not fixing it. So what are here's my question. Scorecarding and things like really digging in, and I'm not saying you need to make it a mandate, but train more rigorously, share the data with your loan officers so that they know it. Why aren't we doing a better job as an industry at getting, measuring the things that matter most, playing Moneyball mortgage, and getting loan officers to do the little tweaks that matter most? Why aren't we getting it done?
I'm going to be controversial. I'm going to use those two words, branch manager. And no professional team today is managed by a player coach. None. Nobody. They tried it. There were a few player coaches through years. I remember I went to a game in Cleveland when Frank Robinson hit a home run first at bat. He was the player coach, right? He lasted about a season. I think what happens, what I've learned in managing retail, if you want to get to these things and manage your business, you have to focus on two things: 2Xing your loan officers. So the commitment is, I'm going to double your production somehow, and I'm going to work on that. And then what we did is we decided that the weakest link in our organization was the branch manager, the player coach. And so how do we get the player coach to actually be able to do the things that you just talked about? And that has to be that we meet with them. So we started meeting with all of them on a monthly basis, bringing them together and talking about all of these things, showing them things to do. But we captured it in what we call 2X, which is I'm going to double your production, or you need to go away. And today you'd solve all your problems if you managed your branch managers and they knew what we were just talking about here and they did a good job and they could double the production. Because really today, profitability is part of its cost, and you just have a bunch of fixed costs that are killing you. But really, it's productivity on the LO side. And if they do one more loan a month, you pretty much solve your problem. So how do you do that? Part of that's product, part of that's service, but most of it is in training around a branch manager. And we just don't train branch managers. It's a Peter principle, and then you become a net branch. And then you sort of become an owner versus, you know how tough this is. I have worked in this business for 40 some years, and I bet you I could count on one hand the number of people that I would rehire to actually run production, who manage salespeople, manage them. There just aren't that many people that are very good at it, right? There are people that call themselves regionals and they call themselves managers but when you want to manage sales, man, that is one tough job, because it's like a daycare or a hair salon on Tuesday, and on Wednesday and Thursday it converts to like a junior high, and then on Friday night it scares the living bejesus out of you, right, as you're going through it. So I think it's tough, but it's the branch manager.
So I did not know that that's what you were going to say, and the timing couldn't be better, because I interviewed a loan officer in the Columbus, Ohio market named Daniel Saw. Do you know who Daniel is?
Yeah. Oh yeah.
Oh, you do? Cool. Yeah. So I came out of that interview with and by the way, he's got a branch with 35 loan officers. I'm going to show a few data points that came out of that. Number one, he became the number one market leader in that market and competes with Rocket. Rocket's like number 3 or 4. Huntington Bank has classically been the market share leader there. And Daniel took it. Like, this one branch manager, he is a player coach. His team is going to close about 370 loans this month. His out of his 35 loan officers, they're averaging 6.4 loans per loan officer in an industry, where it's under 2 right now as an average. And even Rocket, I looked at Rocket's, numbers, and the number of loans that their loan officers are closing, it's high compared to industry averages. But here's one great leader, a branch manager. And the interview that I did, by the way, guys, so for anyone watching this right now, if you go to trustengine.com/10x, I literally created this, guys. So everything that we're talking about, we're training on this. And this first group, guys, this is all these interviews. This is the one with Daniel Saw. So I interviewed him on how was he crushing it as a leader this Tuesday at 9:00 Pacific. I'm not sure when you're watching this interview. By the way, it'll be down here on this 10X page. but I'm going to interview Daniel on how are you training your loan officers to deliver these kind of results? Like what are the best, how to win in this market, and how to train all of your loan officers as a branch manager to win in this market. And by the way, I already got some little clues from the last interview where like they don't train like monthly, they train weekly. They train like when I interviewed Sean Benoshian, the #1 loan officer in America. Sean, how often do you and your team train? 4 times a week. Every, 1 day a week we don't train. So the best branch managers, like they're training their loan officers. They're measuring like when I asked Daniel, how many leads do you have? What's your conversion? Boom, boom. Daniel, what's the production of, loans per loan officer? Boom. The guy knew his market share, he knew his numbers, and he's driving the actions he needs. But I love that because you actually inspired me, Bill, to do more branch manager training.
Well, I think Daniel, like he's a Buckeye, so I'm a Buckeye, so we can.
That's a good thing, right?
That's a good thing for me. I think we learned that as well. So if I would go attend, which I did, like so as a CEO, right, or a president of a firm, I'd attend sales meetings and just see what my regional was doing or what my branch managers were doing. I would say 90% of what happened in these meetings were administrative. There wasn't. So I really only saw 2 or 3 people doing great sales meetings. So what we would do in our branch huddles, what we called them, was we would then start bringing in people who are actually doing sales and doing sales meetings and having conversion discussions. Okay, here, Jim had a call. The call didn't go well. Jim, talk a little bit about the customer and what we did. And then they talk about the solution that they have. Well, that's more helpful to anybody than, okay, look, guys, you got to make sure that you sign the disclosures and you do this well, and look at your pipelines and make sure your pipelines are scraped clean and blah, blah, blah. Right. So I think it is selling. It's learning how to convert, and it's being trained on the job almost as you go. And people like Daniel who do it well, win in markets like this, because this is just a very tough conversion market anyway.
Yeah, there's no doubt. So first of all, anyone that's listening to this live, if you have questions, put them down below. If you're watching the YouTube version, I'm going to do more of these Moneyball interviews. I mean, I'm really passionate about, one, getting lenders and loan officers to play Moneyball mortgage. As a loan officer, you could do it, whether your company makes it easy for you to get this data or not. Guys, there's no excuse. Every loan officer could track all the metrics that I shared below. So, start measuring what matters and how many loans you closed and what your volume was. That's worked during this era. By the way, that was weird. Like a little AI, my hands did something. But it worked in this market. But we now live in a market where 63% of mortgages are, start with 2%, start with 3%. We now are in a market with the biggest affordability challenge, that any generation has ever dealt with. And that's going to require speed to need. It's going to require like just quoting rates. Is it going to do it? That's going to require optimizing your database. It's going to require actually executing and using the tools that your company has. So for loan officers, play Moneyball Mortgage. Bill, I would love for you to give some closing thoughts, maybe some words of encouragement or something for every head of production that's watching this. Any branch managers, like I want you to speak to the managers with a closing thought on, you could do this. And if everybody that was watching this, like you were the CEO of this community and you were giving them direction after this call, like speak to us.
Yeah, I think these are times when leadership leads, right? And managers manage. And I think it isn't a bad, I mean, I've always thought mortgage is always a roller coaster. So as a branch manager, I think investing in your people and spending time with people, I mean, is really the focus. And what happens is, I think we have a tendency in this day and age to spend more time in Zoom, spend more time in looking at data, spend more time on social media and different things. Look, what wins in mortgage is being in the presence of a prospect and being in the presence of your people all the time. So go see them, help them understand their problem, their challenge, make them better, and you will win. I mean, it's not, I think, and you've got, the trust. I mean, you guys, you look at even changing the name of the organization, right? Trust is broken in moments like this between the employee and the employer. I think, so first thing, kudos to all these companies who are surviving and making it happen, right? Because it's not easy. The second piece is you then have to just get better. And the way to get better is to train and develop people and really help them understand that this is not it's not easy to manage and grow sales. It isn't. And to keep and retain your salespeople. So when you look at the things, you've given people today easy ways to get better. So I just say, that is your job. Don't waller in, oh, interest rates are going up and they may come down and we don't have enough inventory. And if I watch one more thing about wars, the election and everything else, I just, I don't know that I would want to be alive. I think what you have to do is just focus on what you know you can do and get better every day and focus on improving your organization, right? And this is the time to do it, because everybody is sort of, like I've always said to you, I mean, the formula is simple. Change only happens, and you can only make it happen when three things exist, right? The formula, C equals DFR. Dissatisfaction, fear, and resistance to change have to be so broken down that you are saying, I'm ready and I will improve. I will change. Think about it. When you move, when you lose weight, when you change relationships, when you do anything that is important, right, or monumental in your life, for it to happen, you have to have those three ingredients. This is the time. And the people that are leading these organizations well, and I see a lot of them, man, I am impressed with how many people are surviving. This has been a long, problem, right? So I think for people to accept these challenges and to continue on, look, you are, I think, surviving. Now it's time to thrive. And I think you can do that by just focusing on getting better every day at what you do.
Great closing thoughts. I'm gonna close it with, guys, just really super tactical. If you just, it's winter, like we're in Q4, it's winter figuratively speaking in the mortgage industry, and it's winter, I noticed by the jacket you have on, it's winter everywhere. Even in Vegas, Bill Dallas is wearing a jacket.
Yeah.
But if
Blood
you
thinners.
focused in this winter market on concessions and conversion, and then I love that focus on your branch managers to like pick some strategies that will work, and get your managers, because they are all, player coaches, get them to lead by example. So, all you regionals, all you head of production, your managers need to lead by example around best practices, whatever your company's best practices are around how do we negotiate a price concession. Have a 3-step playbook. I mean, we've got one here at MortgageCoach. How do you optimize and get the most loans out of your database? That's conversion, by the way, turning data into dollars. But if you just focused on those two things, couple ideas. You got your branch managers trained up, leading by example, and trained up on managing their team around those two metrics. Like, we can't solve all our problems, but we can solve a lot of problems, and we can be ready for spring home buying season and have an even better spring home buying season. Bill, anything else you want to say before we wrap up?
When I first started, a guy came when I didn't know anything about managing a salesperson. He basically said, let's make this very simple. And so I do this. And that's how I started my business. It's how I grew it. If I hired a person, I would meet them in the morning and lay out what they were going to do. I would meet them in the evening and see how they did. And we do that every day until they got better, right? That didn't take me very long to do it. And it didn't take me very long to know whether this person could succeed or not at what we were trying to do, right? So I think it's getting back in that trench a little bit with the people that are around you and focusing on their issues and how they can get better. And like you said, if you got fallout on the left and retention on the right and the deal in the middle, and you're looking at conversions or concessions, that's really the business, right? So how do you do that really well? Now you've closed a loan, right? You've closed a loan. Okay, great. Let's figure out how I can extend. Who does that person know? Who could they tell? Did they fill out their survey? Did they tell everybody that they knew that we did a good job? Can I help anybody else that you know? Right? Is there any way now? Put them in a database so I can talk with them on a regular basis and say, look, blah, blah, blah. I mean, it's just retention's got its strategy, fallout's got its strategy, and closing the deal has its strategy, and you got to help them.
Great closing thoughts, Bill. I appreciate you, my brother.
You too, man.
Good having you here.
You too, buddy. Thank
Everyone
you.
watching this, if you haven't already subscribed to our YouTube channel, subscribe now. Share this with your mortgage friends, whether they're, up the food chain in leadership management, whether it's your team, whether you need to watch it again, or whether you just want to share it with your mortgage friends. Hope you got value. Take care, everybody.